In this video, I'm going to start with an overview for product costing of purchased items. Before I start, if you are someone who is studying cost accounting and you know the difference between perpetual and periodic inventory systems, you should know that periodic inventory system is outdated. It was mainly used because it is very simple to maintain financial entries when using this method, and using an ERP system, we no longer need this. Since in the ERP system, any financial transaction related to the goods movement is posted automatically. So anything that I'm going to explain in these videos is related to the perpetual inventory system. Now, putting that aside, you should know the difference between costing and the pricing. So the price is any money that you pay to the supplier for the item that you purchase, or the money that you collect from your customer for the items that you sell. This is our price. While the cost is the value of the inventory in your financial books. And this can be very different from your price. So for example, if you are buying an item for 10 USD, so this is the price of the item, 10 USD. But we also have to pay other expenses in order to get that share to our warehouse. So we have to pay freight, we have to pay customs, duties, handling fees, anything. So the cost in our inventory books should equal to the total cost of making the product ready to be used or sold. So this should include the price that we pay to the supplier, plus the freight, plus customs, plus duties, plus any expenses that we paid until we get the product to our warehouse. And this is also called landed cost. So the cost can be different from price, and it is usually different actually. Also the same for selling. So after you manufacture a product, you are going to have a cost in your inventory box that is different from your sales price, because the sales price is equal to the cost plus your profit margin, because we are in the business to make profits. Now there are two main inventory costing methods available. The first one is moving average, and the second one is standard costing. Moving average can also be adjusted to first in first out or last in first out. And the standard costing can be adjusted to actual costing, which is part of the material ledger module. Now in the next videos, I'm going to explain each of these methods.